All right, hi guys. So in this session, we're quickly gonna be going through the medium time frame setup. In our last two sessions, we obviously went through our steps, time frame, POI, step one, higher time frame narrative. We did the medium time frame. So now, wait. No, now we're gonna do the medium time. We actually finished the higher time frame. So now we're gonna go through the medium time frame, and then the last session we're gonna be going through the lower time frame. I took you guys through basically the process from a higher time frame to we're gonna look at the medium time frame, and then I took you guys through the pure. I said on higher time frame I typically only look for supply and demand zones. Then on a medium time frame I might look, and lower time frame I might look at order blocks because they are more refined supply and demand zones. How do we find supply and demand zones? We obviously look for a candle or a group of candles that led to a break of structure, and then we're looking for like engulfing candles at that area. We'll obviously go through the charts. I'm trying to keep these videos as low as short as I can. So going to the charts might cause them to be long, so do bear with me. And then we went through the higher time frame setup. What's the first thing I look for when I look at a chart? I look at the higher time frame. 4 hour time frame. I want to see my recent break of structure. I want to see my strong high, my high, and I want to see my strong low. This obviously with a bullish market structure. On a bearish market structure, I obviously want to see my break of structure to the downside. I want to see my strong high, and I want to see my weak low. Once I see that and then mark my supply zone, if I'm in an uptrend, I then mark my demand zone on a higher time frame. So then I then wait for price to come back to this zone. Once price comes back to this zone, I'm expecting to see some medium time frame confirmations, which we're going to be going through this lesson. Then from there, then we go up. Then if then I'm trading obviously the continuation. I want to see price come into this zone. There's supply zone. Once it gets into the supply zone, I'll see some medium time frame confirmations, lower time frame confirmations, and then I can enter the trade for the continuation. Remember, we said you can trade from low to up, but this is a much riskier trade. We wouldn't advise it. We want to be trading in the direction of break of structure. We want to from premium pricing. I went took you through premium pricing, obviously in a demand zone. So this is a much more higher probability higher time frame setup. So now we're going to be going through the medium time frame setup. We're going to be looking at, so once price has moved in, now price broke structure, and now it moved back into this zone. So now once price gets into this zone, what exactly must we be looking for? Then remember, with trading, things don't always turn out exactly how you want them to be, but you need to know what is it that you are looking for when you're looking at the chart, so that when you get it, you know you have it, and then now you know you can take your trade. All right, cool. So with the medium time frame, I'm looking for an order block. I'm looking for a clear order block, a candle that can show me where did this break of structure actually start. So I can see that actually this break of structure started somewhere here with this bearish order block, because we're looking at we are in an uptrend. We are looking for a bullish break of structure. How do I know that I have a bullish break of structure? You can use this indicator. Again, the fractal high and fractal lows, even though I like using it on higher time frame, but for the purpose of this lesson, I'll show you how to use it as well on this medium time frame. So you can see here that it gave you these two fractal highs. So these fractal highs were broken. We had this candle closed. In fact, this one closed above these fractal highs, then moved up. So as soon as this happens on a 30-minute time frame within that zone, again now I just didn't highlight it, but let's say we are within that higher time frame POI. We are in that now. Price came in into this zone. Now we want confirmation. This is a confirmation setup. So in this zone, we can see price is starting to push up, but we don't know when to get in. We don't know where must we now get in. We start to see that price within this 4 hour zone that we talked about in the last two sessions. Now price is starting to push up, because we're expecting it to push up in that demand zone, but we don't know where exactly must we get in. So now I see that price break structure. So once it breaks structure, I know, then I'm like, okay, now we've broken structure. Where did this move originate? It originated from this demand candle. Demand candle being the order block being the last bearish candle that sponsored the move up. So now I'm expecting price to push into this zone, then give me a lower time frame break of structure. This is where I make my entry to the upside. But now I want to take you through liquidity. I always talk about liquidity because liquidity is important. Remember, on our steps at the beginning, I said that on a medium time frame, the first thing I want to confirm is a break of structure. So now, on the example I showed you lower, we see a break of structure. Then I want to confirm a high probability zone, which it is the high probability PI, which is the order block. Then after that, I want to identify possible liquidity in front of that zone. I want to see possible available liquidity forming in front of that zone, also known as inducement, right? Because market makers know that we are looking at this breakout structure, we want to trade to the upside, and they know that human beings were emotional and we don't want to be missing out on trades and all of these things. They will then induce a lot of buyers to get into this zone. They will then induce buyers. They might also be inducing sellers because some of the sellers, they are looking at this thing. They're like, no, it's coming down because Vela Kere, when it came into this zone, it was in a medium time frame downtrend. So some of them traders are looking at this thing like, okay, no, it's gonna start coming down at some point. So it starts coming down. They're inducing sellers. They're inducing buyers. So all of this is called inducement. And you'll find that most of the time in the market, they might push price down, and just before the zone where they actually want to enter, they will push price just to create what looks like a consolidation. Nyana. It might even come as close as this down here to induce people and sellers to believe that this is called manipulation now. To believe that the price is going further down, and for buyers to also feel like, no, we know it's going up, we don't want to miss out, so we want to get in here. So, liquidity means taking people's money when they are triggering everyone stops. They would push the price down into the actual zone that they want to get in. So, with this SMC trading strategy, our our um our strategy is to identify zones where institutions will always look to get in after taking liquidity. So hence I'm saying I want to see liquidity, I want to see available liquidity in front of the zone that I want to enter. Whenever there's no liquidity available in front of the zone, usually what price would do is it would come into this zone and take liquidity, maybe push the price down here, take liquidity, and then it pushes up, right? So hangata, when there is no liquidity in front of the zone, this zone itself will be used as liquidity. So this is something you just need to be mindful of. But at this point, in terms of how we're trading, it might not be a trend smash because you're not entering exactly at this point when price gets here. You're not looking for entries, right? You're looking for further confirmations as well on a lower time frame. So this is why having three time frames is important, because the medium time frame tells you when the higher time frame turn is happening. So the 30-minute break-up structure is telling me that, okay, the 4-hour move, yani netafat, it's finished. So now I'm expecting it to start turning to the upside because now I have a what? I have a medium time frame break-up structure. So now when price gets into this level here, I don't know if it's going to blast through it. I don't know if it's going to reverse. I don't know if it's going to reverse here, it's going to reverse here, it's going to reverse here. So that's why the 1 minute is so important. Hence, I'm gonna show you when we go through the session where we talk about lower time frame setups, because I don't know where it's going to stop, and I'm looking for a good risk to reward ratio. I want to risk as little money as possible to make as much money as I can. So that's why I want to look for trades at lower time frames, because I don't know where this 30 minutes is going to stop and start turning. So the 30-minute tells me where the higher time frame retracement is ending, and then the lower time frame tells me where the medium time frame pullback is ending, and I can start looking for my entries. Né? So once you start waiting for price to get to this zone, don't take any trade until price interacts with this zone, because you're gonna find that maybe sometimes market makers are just taking liquidity, and then they, if there's no liquidity in front of this zone and they want to turn from this zone, they might push price further down to take out this low. See this low here, that might push price further down so that they can take all of the liquidity, because some people open positions here and they had left their stop losses, so they might push it down here if there's no liquidity. So when there's no available liquidity in front of the zone, you'll find that price will take liquidity past the zone and then they'll push price up. When usually there's liquidity in front of it, this increases the probability. Remember, nothing is guaranteed in trading, we are calculating probability. So hangata, you'll find that once they've taken liquidity of with the liquidity zone in front of the zone they want to enter, they will not even bother to go down here unless if all the orders that they want to open is not open. Look, anything can happen, but you just need to be aware of these things that they do happen. So this is why it's important on a 30-minute time frame that you look for liquidity zones. On a 1 hour time frame, hence I've reverted back to the 30 minutes. Sometimes I could use the 1 hour to find my zones, but I like the 30 minute because it's able to give me a little bit more detail when I'm looking for those liquidity zones, and I want to see where market makers might want to grab liquidity before pushing price in my direction. If you don't know where liquidity is, you will become liquidity. It's a very important rule when trading the markets and taking consideration liquidity. If you don't know, if you can't see where liquidity is, my friend, you are going to become the liquidity. So you need to know where it is. So medium time frame, price comes into my big zone here on the 4 hour time frame. It's in there. So I'm waiting for a break of structure. It starts pushing up. I don't know where I need to get in. I see a break of structure. My indicator is telling me that I have a fractal high here that is been broken. You can see the indicator as well. Né? There are highs here, but it's not telling you there's a fractal. So there's a criteria this indicator uses to be able to tell you which ones are significant highs. You can see we have had highs from here, but it's not telling you. So this is significant. So that's why it's called a fractal high. So once a fractal high is broken, then I see that no, I have a nice break of structure here. Then I'm expecting price to push back into this zone. So don't take a trade on the 30-minute time frame here before it reaches this zone. You can enter on sorry, excuse me, on 30 minutes if you want to, but I would advise that you look for where liquidity is. If there's no liquidity in front of the zone you want to enter, this zone might be used as liquidity. And if you're entering here, you will become liquidity. Né? Cool. Then we can continue. Like I said, I want to see a medium time frame break of structure to the upside when I'm trading a bullish market. I want to see available liquidity in front or above the medium time frame POI, and I want to see price taking liquidity and mitigating that POI. So I want to see price take its liquidity. Then I know price is taking liquidity. It moves down here to mitigate the zone. That's where now I know I can enter confident. Now we move to a bearish example. I'll try and go to trading view, guys, and try and show you some examples, but this is a screenshot from the live market so that you can have a better understanding of the markets. All right, cool. So now here again on a medium time frame, I'm not looking at the entire zone like this zone. On the higher time frame, I might look at this zone. It'll be holding a little bit bigger, but on a 30-minute time frame, I'm looking at the order block. I want to see the order block, right? So now here I'm expecting price to push up to this zone and then push further down. It might, because I identified another zone above here, but it's not important for this exercise. What's important now for this exercise is I've seen that there is a fractal low here being broken. Price made a huge move down, an aggressive move down here, so indicating that there is some supply here. So I see that price got here and then it made an impulsive move down. Then again, liquidity, they push price up, and just before the zone that they want to enter again, just before the order block, they stop the price. inducing what the sellers to come in because they've seen that price is coming up. They also want to induce the buyers to believe like no, no, the price is still going to push further up. The sellers are thinking, no, price is still gonna come down. So now they want to induce traders to get in here on positions, and you see how careful they are. They just created to this zone because they know that a lot of people might be looking at what at this zone. Then they stop price here. Well, now what were we doing? We're looking for the order block, right? Because we know that this is a zone that they might use to be able to push further down. So here, this is a zone they might use to grab liquidity. This is a zone that they might use to grab liquidity. So liquidity is usually grabbed at significant highs just below a a POI. They also can be taken from equal. This is a perfect example. It actually shows a high. This is actually also a low that where liquidity can be grabbed. This is equal highs and equal lows where liquidity can be grabbed just before your POI. So it's important when you now a given price came into this big zone that we had on the 4 hour time frame. Price is in there. Price is consolidating. Now we start seeing price moving down because why? It's a supply zone, so we're expecting price to push further down to break structure on a 30-minute time frame. It starts breaking the structure within that 4 hour zone. Right within that 4 hour zone, I see a 30-minute break of structure. Then I'm expecting price to what to pull back into this POI, which is in a medium time frame, the order block. I'm expecting it to come back. It doesn't. It stops here, then creates and inducing people to believe that price is going further down, inducing some traders believing that price is gonna go further up, and then this is a liquidity trap. They call it liquidity trap. So what happens then is, or what we're anticipating to happen once we've identified these liquidity zones, again, if you don't know where liquidity is, you will become liquidity. So now they expecting price to push into this zone before it pushes down because market makers need all of these traders' money to be able to open their big positions to push the price further down. So money moves the market. Wherever money is, that is where market makers want to go and grab that money so that they can move the market. I hope it's clear. On a bearish point of view, I want to see a break of structure to the downside. I want to see available liquidity below the medium time frame POI in front of it. So knowing where available liquidity helps to choose a low risk, high probability POI. So whenever you know and you can identify that, there's some liquidity in front of this POI, in front of this order block, then you know that this is obviously a much lower risk trade, but with a high probability. Nothing's guaranteed in trading, but what we want to do is we want to increase our probability of winning the trade, and knowing where liquidity could be grabbed before they push the price down or price up in your direction will help increase that probability. Né? So if there is no available liquidity above or below the POI, this means like a high probability that the POI itself can be used to grab liquidity. So let's say for argument's sake, um, I want to enter this thing, but price breaks and then goes straight into it, not giving me this liquidity. So then that tells me that chances are they might use this zone to grab liquidity. So maybe I can then target this the one above. Yeah. So I know that no, we have equal highs here. So they didn't give me this inducement in front of this zone. So they might actually grab liquidity here and tap into this or mitigate this zone, push the price down. So we need to always try to see where liquidity is that they might want to grab before they move the price in our intended direction. So liquidity is very important. I like saying that price action is king. If price action is king, liquidity is the queen. So we need to definitely be in line to see what liquidity is doing, where it might be grabbed, because money moves the market. If money is laying in somewhere in any level in any zone, that's where market makers will go to try and grab that liquidity so that they can move the market. So this is the third lesson, third session on the medium time frame setup. So I'm just going to be taking you through the low time frame POI, low time frame setup, and then our series will be completed. I felt it's important to break up these sessions so that I can try to go a little bit more in detail. I don't want this video to be long. Let me try and go on trading view here. So let's say for argument's sake, we have this big zone. Let's say this was our higher time frame POI for whatever the reason. So we are on a 30-minute time frame now. So let me remove it. So what I want to see on the 30-minute time frame, let's say I'm in my zone. So now I'm expecting price to push up. So I'm in my demand zone or supply zone. I'm gonna only make a demand zone example due to time. So this is a 30-minute time frame. It breaks structure here because I'm expecting it to what? To move. It breaks structure here. Once it starts breaking structure, I'm expecting it to what? To pull back into my order block. Cool. Look what price does. Price breaks this high, comes down here, but doesn't mitigate this low. This is exactly what I was saying about um, liquidity. So this is an order block after this break of a high. Price breaks the high, then I'm like, okay, I'm expecting it to start breaking highs because I want to get in on a buy because I'm at demand. I mean, I'm within a higher time frame demand zone, so I want to see some break of structures to the upside. Then they bring price down just before this zone. They stop the price knowing that the buyers are looking at its breakup structure, they will give you that. Knowing that the sellers are still seeing it, maybe some sellers are still seeing it as a bearish move, they will start trading bearish. The buyers are starting getting in. Then at exactly at 3, they push price up, taking all of this liquidity that is lying here, all of the people that had their positions open here, they've taken their liquidity. All of the sellers that open positions here, they've taken their money. So now, because the sellers that were opening here, they came for them taking their money, they come take the money for the what? For the buyers who opened their positions here, who could not wait until price tapped into this order block. So this is exactly what I'm talking about to say. If you're not aware about these liquidity traps, these inducement zones that form just before important levels, then you will form part of liquidity. Sometimes even me, I get caught in liquidity traps if I don't realize where I am in the market. But obviously, because it's a trap, they're gonna try to catch you out. But this is essentially what we need to do by waiting. That price needs to get to this zone. I want to see some inducement in front of that zone being formed. Look exactly what they do. They break structure, bring it down just before this zone, the way they want to actually enter. They pause the price just in front of it. And this is what they do it a lot. They pause price just in front of it to create inducement for buyers and sellers to get in. They push the price up while the buyers are busy, happy in profits. They tap them out, take their money, then only then push the price up. Um, I don't want to look for a bearish example, guys, due to time. Um, okay, let's look at this one. Bearish, they break structure here. Let's say we are at a bearish zone for argument's sake. We are in a bearish zone. This is my 4-hour zone here. Let's say we are in my zone for argument's sake. Gosh. Let's say we are in this in my bearish supply zone for whatever the case may be. I want to do it quickly. We break that structure. Once breaking that structure, we create this order block here. In fact, yeah, we created this order block here, this zone here. Price creates this zone. Oh gosh. See why I didn't want to come here. Price creates this zone. It also breaks structure down here. Break structure down here, creating this order block. this one here. So it breaks structure. As I said the last time, price might not always go back to this zone. It might break structure further down. So if it breaks structure further down, you rinse and repeat the process. But it is just to be mindful of this zone that it hasn't been mitigated. Mitigated means it hasn't price hasn't come back to test it. Ne? Cool. Then now it moves down again, breaking this low again, creating this trap. This is a trap here, creating this order block, another trap, right? They come in, then when they get here, they create this inducement in front of it, right? But I wouldn't be trading this one because it's too far from the first one. I would probably be looking because no it's in it looks like it's in what is it demand discount discount price. It's too far down and I'm trying to sell, right? If I want to sell in premium pricing. So this one is too far down. It looks like it's in discount price. I'm just not gonna go to the 4 hour and check. It's just too far down, so I wouldn't be looking at this one. I might be looking at this one. This looks, maybe this one is in the 50% range. This one is definitely in the extreme zone. So this would be the best order block to enter. This would be the second one because it looks like it's in premium pricing, but it looks like it's just in the middle between 50% of the Fibonacci retracement. Let me check. Block structure. Yeah, exactly. You see, it's in there. If I were to take this high all the way to this low, this one is in premium pricing. So this one down here is in discount price. It's just too low. So this is clearly a trap. We cannot be trying to sell at cheap prices. I want to sell at premium prices. I want to sell at high price. So this one is nicely up in the sale. So this is a high probability order block. So okay, cool. Apologies, price comes in, goes in, then those that are looking at this breakup structure to create this one, it taps them out, creating all of this inducement, creating all of this inducement. Then now, because it has already tapped these guys out, this is all liquidity, all of this here, this is all liquidity waiting to be grabbed, this zone here. This is all liquidity. So they come back to grab the liquidity, tapping, mitigating this zone. They come back down. That's when they start going actually into this zone to make their move down. So we must always look at where liquidity could be grabbed, and we also need to look at premium and discount pricing so that we make sure we choose the right order blocks. This is where I'm gonna cut it off, guys. Looking at the medium time frame setup. After then, we are done here. I'm gonna go through lower time frame to show you that once price gets into this zone here, because this is a 30-minute zone. So price, you saw it took liquidity. This long wick is liquidity. So now when price is here, like you see it's here on the 30-minute, what must you be looking for to get that last confirmation to be able to enter for your sell or for your buy? Other than that, thank you.